Hi all, and welcome back to the channel. It's April 20th, and today we're talking about Costco, ticker COST. And I want to start with the question almost every investor asks the moment they look at this stock. How does a retail company with low margins trade at a premium valuation and still keep rewarding long-term shareholders? Because on paper, Costco looks expensive. And yet for decades, it's crushed expectations, outperformed most retailers, and quietly built one of the most loyal customer bases in the world. So in this video, I'll break Costco down in plain English. How Costco actually makes money. Why the membership model is the real business. Why investors keep paying up for this stock. What could go wrong? And whether Costco makes sense today. And before we go deeper, let's talk price targets right away so you understand the upside and downside. At the time of recording, Costco is trading around $1,000 per share. Here are three realistic scenarios. In a bearish scenario, if consumer spending slows, traffic cools, or the market stops paying a premium for quality, Costco could realistically fall into the $850 to $920 range. That wouldn't mean the business is broken. It would mean the valuation reset. In a base case scenario, if Costco keeps executing the same playbook, solid same-store sales, growing membership fees, high renewal rates, a reasonable range over the next year or so is about $1,050 to $1,120. In a bullish scenario, if membership income keeps compounding, international growth stays strong, and the market continues to reward consistency, Costco could justify prices in the $1,150 to $1,250 range. Those ranges line up with where many analyst targets cluster today, generally in the low to mid-thousands. Now let's talk about why Costco is different. The biggest mistake people make is thinking Costco is just a retailer. Costco is not really in the retail business. Costco is in the membership business. Here's the core idea in one sentence. Costco sells memberships for profit and then sells products close to cost to keep members loyal. That's the entire model. Most retailers try to make money on every item they sell. Costco flips that around. It intentionally keeps margins low so customers trust that they're always getting value. That trust is everything. When customers believe Costco is the fairest deal in the room, they keep renewing. They keep shopping. And they keep coming back. That's why membership renewal rates matter so much. Costco's renewal rate in the US and Canada sits around the low 90% range, with global renewal rates just under 90%. That level of loyalty effectively turns Costco into a massive subscription business. And subscription-style businesses are valued very differently than traditional retailers. Now let's talk about the warehouse model itself. Costco limits product selection. It moves inventory fast, it negotiates aggressively with suppliers, and it uses massive scale to keep prices down. The warehouses aren't designed to be fancy. They're designed to move volume, and volume is the key. High volume gives Costco leverage with suppliers and keeps costs per unit low. That allows Costco to price aggressively without chasing margin. Here's something important that people miss. Costco's thin margins are not a weakness. They're a strategic choice, because thin margins build trust, and trust builds loyalty. And loyalty builds recurring membership income. That's the flywheel. Recent results show that flywheel is still spinning. In a recent quarter, Costco reported around $68 billion in net sales, up roughly 9% year over year. Net income was a little over $2 billion. And most importantly, membership fee income rose roughly 14%. That last number matters the most. Membership fees are the highest quality revenue Costco has. Now let's talk about the bull case. Why investors love this company. First, the membership model creates predictable profits. Even if the economy slows, people still buy groceries, household basics, and essential items. Costco tends to perform well in both strong and weak economic environments because value always matters. Second, the brand is deeply trusted. Customers believe Costco is on their side. That's incredibly difficult for competitors to replicate. Third is what people call the treasure hunt effect. Costco isn't just about staples, it's about limited-time deals, seasonal items, and unexpected products. That creates excitement and drives frequent visits. Fourth, operational discipline. Costco does not chase trends. Management repeats what works, stays conservative, and avoids flashy experiments. That consistency is a big reason investors are comfortable paying a premium. Fifth, long-term growth. Costco is already massive, but it still has room to expand through new warehouses, international markets, and higher-tier memberships that drive more spending per customer. Now let's be fair and talk about the risks. The biggest risk is valuation. Costco almost always trades at a premium to other retailers. That premium reflects quality, but it also limits future returns if growth slows. Second, consumer weakness. Costco is defensive, but it's not immune. Big-ticket discretionary items can slow during tougher periods. Third, margin pressure. Rising wages, transportation costs, and supply chain challenges can squeeze margins. Because Costco prioritizes low prices, it can't easily raise prices to protect profitability. Fourth, competition. Walmart, Target, and other warehouse clubs actively compete for value-oriented customers. Costco's advantage is loyalty, but competition never goes away. Fifth, international execution. Costco has done well globally, but expansion always adds complexity. Different markets behave differently. So, how should you think about Costco as an investor? Here's a simple framework. First, track membership fee income growth. That's the engine. If it keeps growing, the business is healthy. Second, watch renewal rates. High renewal rates mean customers still see value. Third, follow same-store sales excluding gas. Gas prices can distort numbers. Underlying demand matters more. Fourth, keep an eye on warehouse growth and traffic trends. Costco wins through scale and volume. Now, the big debate is Costco too expensive? Here's the honest answer. Costco often looks expensive, but it's not valued like a traditional retailer. It's valued like a high-quality, membership-driven compounding business. The market is essentially saying, we are willing to pay more for consistency and trust. That doesn't mean the stock can't pull back. It absolutely can. But over long periods, Costco has rewarded patient investors who focus on the business, not short-term valuation swings. So what's my verdict? Costco is one of the best-run consumer businesses in the world. The membership model is a powerful moat. The execution is disciplined, and demand for value tends to hold up across cycles. But because the stock is often priced for perfection, entry price matters. This is not a stock to chase aggressively after big runs. It's a stock to build patiently, ideally during pullbacks. If you want a simple way to know whether Costco is still winning, watch membership growth, renewal rates, and same-store sales. If those remain strong, the machine is still working. If you want, I can do a follow-up comparing Costco to Walmart and another warehouse club to explain why Costco earns the premium. Or we can jump back to another AI name next. Comment which stock you want covered next, and if this helped, consider subscribing. Thanks for watching.